Hey traders, Jason here from Levitt Brothers. So in this video, I'm going to talk about the current state of the market. I'm going to show SP 500 monthly, weekly, daily chart, and then a handful of indicators, not indicators, breath readings. The message that I gave Levitt Brothers subscribers coming into this week was that the market was weak. It was trending down. A lot of stocks had suffered big damage. But in the very near term, things were starting to get less bad. So as bad as things were, there were some breath readings that were putting in some higher lows. So we had some positive divergences. So my message was the market's trending down. It's in bad shape. But given breath readings are starting to improve and the market had fallen, I think like 10 out of 12 days, look for a bounce in the near term. That is what's happened. All right, so let's jump in. Let's see what things are looking like here. All right, so here is the S&P 500 monthly going back about 5 years. 3,600 was an important level over here. It was a resistance level here. Market moved up to 4,800, came all the way back down to 3,600, and then moved up to 4,600. So without realizing it, COVID was over here. Without realizing it, the market has traded in a range for about 3 years. Okay, we had 2021 was an absolutely fantastic year. It was the best trading we've had in a long time. Lots of big winners. For the first part of 2022, a lot of weakness. Okay, a lot of stocks suffered big losses. The SP 500 here fell from 48 to 3,600, which is a lot, but a lot of stocks fell a heck of a lot more than that. Then we got a nice bounce off of that, and then we got to move down from there. The move down here was enough to neutralize the uptrend, and then the move up here was enough to neutralize the downtrend, and now the move down here, as of last week was almost to the point where it was neutralizing the uptrend. And then you look back and realize we've been trading sideways in a wide range for 3 years. The market, so for those who just simply trade the market as it unfolds in front of them, they've done really well. They've made money on the upside. They've made money on the downside. For those who are either perma bulls or perma bears, you could definitely make money as long as you stand aside when the market's moving against your natural inclination. All right, so this is the monthly chart. I think it's pretty neutral here. I would put in a support level here at 3,600. I put in a resistance level over here. 4,200 is a little bit higher than the midpoint there, and that's what it is. So to have a strong opinion right here that the market's definitely super strong or super weak, probably not wise. We could definitely from here, rally up to the July high there. We can actually rally up and roll over and go back to the low. I don't think you can be overly bullish or overly bearish right now, given that the market in hindsight has just rolled up and down in a range for the last 3 years. All right, let's zoom in a little bit. Here is the weekly chart. You can see the pause over here below 3,600. We break out, and then 2021 was just a fantastic up year. A couple dips along the way help set the stage for some further gains. So big rally 2021, big swinging downtrend in 2022. Then we bottomed and we moved up from there. Again, going back 3 years, we got market moves up, market moves down, market moves up. If you're bullish, you can definitely make a lot of money when the market moves up, but you have to stand aside when it moves down. If you're bearish, that's fine too. You can make a lot of money when the market goes down, but make sure you don't get caught in a short squeeze when the market's going to trend up for several months. So here we are, pretty neutral. Okay, market moves up, market moves down, market moves up. Now it's moving down, bouncing off 4,200, which has been a key level. From here, I don't think you can have a strong opinion. You just can't. Okay, anyone who says, purely based on the chart, I just don't think you can have a strong opinion. I don't think you can say like the market is definitely strong or definitely weak. It's moving up and down, and you'd be wise to just kind of turn your brain off and just go with the flow of, whatever's happening at that point in time. All right, let's go into the daily chart. Daily chart looks a little bit less constructive because you can see here early parts of the year, January, February moves up, comes back down and tests, moves up, nestles in here to to 4,200, breaks out, as you can see, and then has a really good June and July. Then it's been stair-stepping down ever since. This drop over here has been enough to like completely neutralize any bullishness that happened over here in May, June, July. Okay, so it got rejected by the 50 there, fell right, got support at first from the 200, fell below that, fell below this level, fell below all key levels, and now we're going vertical after that. This is great, making a few bucks on the upside, but I don't think we can get too overly excited. To me, the most bullish thing that can happen is we come up here, get rejected by the 50, come down here, get supported by the 200, which is the red line, and then we bounce off there and have a nice end of year rally. That, to me, that's the most bullish scenario. But given, it's like down, up, down, up, down, up. Like, I don't think we could be overly bullish here. I know it's the end. I know we're getting into the end of the year, and I know, a lot of people are going to throw out some quant studies arguing that the market's going to rally, have a year-end rally. I hope so. It's a lot easier to make money on the upside than the downside, but this thing is stair-stepping down. The trend is down. I'm long right now, but I'm not like that long. And there's been a lot of big blow-ups with individual stocks, and I just don't think you could be overly bullish right now. Be responsible, okay? It's easy for the market to move, and then for you to turn around and say, I should have done that. You know what? No, you shouldn't have done that, because the market's actually going down right now. It's pretty weak. And there's a lot of things that you look at in hindsight that you couldn't have seen in the moment. All right, let's look at some breadth readings. So this is what I was telling Leverett Brothers subscribers last weekend. What I have here is the S&P 500 up top, and then I have the NYSE AD line, and this is the 10-day moving average, 20-day moving average, and the 50-day moving average. So what I was looking at here is I was just looking at the higher low here. Okay, you can see the S&P 500 drops to a lower low, but we put in a higher low with the 10-day and a higher low with the 20-day. So the AD line was still negative. Decliners were still outnumbering advancers, but by a lesser amount. Okay, so it was bad, but it was less bad. And when things are less bad, those positive divergences often lead to a bounce, which is what we're getting right now. Okay, so coming into last week, the market had fallen, I think like 10 or 12 days. I don't remember the exact count. Things were bad, but they were less bad. So I was warning, hey, be open to a bounce here, because it's probably going to be coming soon. All right, here's another chart, similar situation, S&P 500 up top. This is the 10, 20, and 50-day moving average of the NYSE up-down volume. So the last chart was advancers and decliners. Now we're talking about advancing volume and declining volume. So similar, but different, because advancers and decliners, every stock counts as one. It doesn't matter if you're Apple or some little company. With volume, now the bigger companies that trade more volume get more say-so. It doesn't always work out like that, because there are some cheaper stocks that have a lot of volume. There are some expensive stocks that have less volume, but it's just a measure. None of them are perfect. We have the same divergences forming. Okay, S&P 500 lower low, but the 10-day, 20-day, and 50-day moving average of the NYSE advancing volume versus declining volume, they were putting in higher lows. Okay, so the situation was bad, but it was less bad. It was starting to get better. It was starting to turn the corner. And that's partially why we've gotten a nice bounce this week. Next up, this is the S&P 500 versus the NYSE highs, lows, and the high low. So the green is the highs, the red is the lows, and the black line here is the high low. You can see here that there's been an absence of highs. Okay, we know that, but the situation has gotten less bad. So at this low here, we had that many, like no highs right there, but like that many lows. Market moved up, came back down to a much lower level, and we still had an absence of highs right there. Okay, but the lows never even took out the previous low. Okay, and this resulted in a positive divergence here. So the situation, again, it was bad. When you look at this area right here, you can see lows have outnumbered highs most of the last 2 months, but zeroing in on the end of last week, the situation was getting less bad. Okay, even though the market fell to a lower low, new lows didn't drop to a new low. So it was bad, but less bad, and that typically leads to a turning point. Okay, next up, this is the SP 500, and this is the SP 500 SPX stocks above their 20-day moving average and SPS stocks above their 50-day moving average. The message here was exactly the same. S&P lower low, but less stocks had fallen to a lower low. Okay, so S&P's over here, and then we have like 7% of S&P stocks are above their 20-day moving average. S&P bounces and then drops to an even lower level, and now we have like 11% of S&P stocks above their 20-day moving average. 11 is pretty bad, okay? There's 11% of stocks is pretty bad, but it's better than 6 or 7%, which is what it was a month before, okay? So the situation was less bad, less stocks were being pulled down, more stocks were being able to hold up a little bit, and this set the stage for this week's bounce. Okay, so hope you got something out of this. Market overall right now is not in great shape. The bounce we're getting this week feels good. We've had some good gains. It's nice. It feels good. But don't let your guard down, because we could rally, we could bounce, chop around and then fall back to the lows. A lot of overhead resistance. The indexes are in, the NASDAQ and S&P are not in great shape, but they're not in horrible shape. But if you look under the surface, a lot of individual stocks are just getting crushed. Okay, I don't think it's wise right now to have a strong opinion. Okay, I don't think you should be able to just say like, hey, the market always rallies at the end of the year, I'm just going to like buy. Like, that's stupid. I also don't think you can assume the market's just going to completely fall apart, because the indexes aren't doing that bad. If you look back a couple of years, they're trading in a range. Market just rallied, fell back. Now it's moving up again. Like, that's not that bearish. Strong opinions, loosely held right now. If you have a strong opinion, that's fine, but change your mind if things, if that's what needs to happen, okay? Hope you got something out of this. Good luck. See you next time.